this week's market outlook. Obviously, we'll start off with the geopolitics. So obviously last week we initially saw some signs of de-escalation, with a potential deal being on the cards between Iran and the US. However, markets have now priced it out this week, with obviously oil retracing the whole initial downside move off the back of that news release. Equities are hitting a 6-month low. Bonds continue to skyrocket. The DXY is back above 100. It's all signalling that the market right now, at least, is pricing in the escalation narrative. We even have money markets pricing in US troops being deployed as soon as April, which is obviously another step towards a much bigger conflict, which, as the conflict gets sustained, we're going to see higher oil, continued dollar strength, all those sort of things. So obviously the VIX is up and the ES is up, which is what the intel feed is telling us. So yeah, basically not much has changed from last week, outlook-wise, but also geopolitically. We thought we were going to see some de-escalation, however that got priced out by the end of the week, indicating where markets are expecting this to kind of head, this whole direction to head. Starting off with, we'll start off with the calendar. So for this week, we are focused on, if it wants to load, we are focused on Japanese unemployment, which is forecasted to stay sticky around 2.7%. We've got some RBA meeting minutes on Tuesday, and we also have inflation year-over-year estimate in Europe, which is expected to jump almost 10 basis points, which is quite clear. It's indicating where rates are going to be heading, essentially, and obviously, it's to no surprise, inflation estimations have gone up by 9 basis points, because it's obviously elevated energy prices is contributing to this. And then 3 p.m. on the Tuesday, we have JOLTS, which is forecasted to stick around the 6.85, 6.95 area. Wednesday, we then have headline unemployment out of Europe, which is forecasted to stay around 6.1% as well. So quite a heavy week for Europe, for sure. We've got Swiss inflation on Thursday, which is 0.5% higher than the previous. That's consensus, at least. And then we'll be finishing the week with NFP from the US on Friday, which is forecasted to improve by 48,000 jobs. And however, the unemployment rate is expected to edge up to 4.5%. So yeah, to be honest, I don't really see much getting priced in here this week apart from this. So come on Monday, Tuesday, we should probably see some euro strength as we get closer to this print. And then obviously that print may decipher where we go from there. But obviously eyes will be on yields. So starting off with the US dollar. We are still bullish on the US dollar, as we have been for the last month. 2 months maybe even. As mentioned last week, flows should remain in favour of the dollar. As the war continues, oil prices remain elevated, short-end yields continue breaking new highs. We're almost at 4% on the US 2-year, which is obviously the market starting to price in hikes instead of cuts, which is obviously hawkish. This is following last week's PMIs, which came in pretty healthy, and the hawkish FOMC meeting we had 2 weeks ago. For the week ahead, the main data point, as mentioned, is going to be JOLTS, which is expected to stay steady. And as always, we just need to kind of take it day by day, because the major driver of this current market is obviously what's happening in the Middle East. So every day come to the charts, look at what oil's doing, look what equities are doing, look what bonds are doing. Are we starting to price in de-escalation, or are we pricing in escalation? So yeah, that is essentially it for the dollar. The Fed watch is 95% for a hold in April, 92% for a hold in June, 90% for a hold in July. And this is obviously like 2 weeks ago, or let's say a month ago, this would have been at 20% for a cut, 50% for a cut, etc. So we're obviously having a hawkish repricing in the front end due to these energy prices. If we look at what the institutions are saying, Credit Agricole, bullish on the dollar. Barclays see end of month flows supporting the dollar. That is essentially it for the dollar. Moving on to the pound. We remain bearish on the pound. Obviously, the pound did decently 2 weeks ago due to its rising yields and massive repricing in the short end of the curve. However, I think this is, at the end of the day, going to be faded. Data's very weak, And to be honest, the economy is not in a great spot. So having these rising yields, although it seems hawkish, is actually going to be a bigger detriment to the economy than the rising rates for the currency. So yeah, I mean, that's essentially it with the pound. As long as energy prices remain elevated and the escalation narrative remains, we should see downside in stuff like GCAD, GU. I mean, CPI last week as well came in more dovish than expected, which is supporting the thesis of sterling downside. So yeah, GCAD, GU, GNOC, these are three pairs I'd be looking for shorts for sure next week. And I mean, if we just look at what MUFG said here, they say that the pound being the top performing G10 currency after the dollar does not make any sense, and there's a downside risk ahead. So yeah, MUFG research flags downside risks for the pound in the near term, and we agree. So yeah, bearish on the pound this week. Moving on to the euro. So we are neutral on the euro this week, however bullish on specific crosses. So I'll go through this. Obviously, we're having ECB rate hike expectations gaining traction in markets, with growing speculation that tightening could begin as early as April, so very soon. Institutions like Barclays, JP Morgan, they're all forecasting an initial rate hike in April, followed by even further rate hikes in June and July, reflecting a rapid shift in policy expectations due to the energy crisis, essentially. And I mean, it's evident from 2 weeks ago's ECB meeting that the market is definitely a fan of the euro due to its hawkish repricing. And the market is just preferring the rate hike narrative from elevated energy prices right now. So stuff like Euro Yen, what else is there? Euro NZD, Euro AUD. We should continue to see these move to the upside. CAD. We are bullish on the CAD, obviously due to oil. However, as we said last week, the NOK is definitely the preferred cross if we're trying to express oil. If we're trying to express some risk, definitely the NOK. High base rate, very oil export driven economy, and its price action, for me at least, is way cleaner than the CAD. Because obviously with the CAD you then have the influence of the dollar's movements. So let's say NFP comes in terrible, the CAD's going to have a slight pullback. However, the NOK isn't if oil. This is obviously if oil remains elevated. So yeah, that is essentially on the CAD. We're bullish on the CAD. However, the NOK is giving us better entries for sure. Obviously, institutions are bullish for the most part on the CAD at the moment. Australian dollar, we remain neutral. To be honest, I just want to kind of leave it. Took a loss maybe 2 weeks ago on AUD upside, just because, to be honest, equities are just melting. 6-month low, as mentioned. Gold is melting due to the US strength and hawkish repricing. So obviously, this is going to limit Australian dollar gains. It's a very equity-driven and gold-driven economy. Markets are clearly not a fan of AUD. So to be honest, I'd rather stay away. Long term, it definitely makes sense for upside. However, if you only long term, really, if I was to enter now, it would be long term. I'd have wide stops, and that's obviously then forecasting there to be de-escalation. So definitely a very speculative play, which is why I'm leaving it for my week-to-week stuff. But yeah, New Zealand dollar, we remain bearish. Not much has changed here. Major oil importer. Equities showing massive risk off. I mean, if we just look here, risk sentiment is at 13%, which is just super risk off. Yeah, I mean, the institutions are for the majority bearish on the New Zealand dollar. Longer term, similar to the AUD, I'm definitely a fan of the New Zealand dollar longer term, but right now in this week-to-week environment with the Middle East conflict going on, leave it for me at least. Japanese yen, same thing as last week, bearish, massive oil importer. However, dollar yen has hit the 160 handle, which is obviously now bringing about a massive intervention risk. So we just need to be very careful with dollar yen, at least, where we're going to get in, because all you could wait for is Bank of Japan or the US to intervene, and bang, you're wiped out. So yeah, definitely careful. And then, as you can guess from gold's recent price action, we are bearish on the Swiss franc, basically due to that correlation. That is what's driving the Swiss franc at the moment. It's not risk on, risk off, it's gold's movement. So yeah, bearish on the Swiss franc. Now let's get into the technicals. So So, starting off with the US dollar. Obviously, we've broken above the 100 handle again. I really like a long position off this level here. 1-to-1, wider stop for sure. And then, to be honest, we could target a 1-to-2, 1-to-1. The macro makes sense. The technicals make sense. And it's all indicating upside in the dollar, really, which is why we are also looking to short the pound against the dollar from here. Similarly to GCAD here. However, as mentioned, GNOC is definitely the preferred short. However, that will be from up here. NU, somewhere around this level, but the price action is very, very aggressive to the downside. But I definitely like shorts from maybe the 0.575. So if I just get this tool out, go here, 0.575, 0.5775, sorry. This makes a lot of sense, to be honest. Key level, clear respected level, and the macro follows it. NZD CAD, shorts from this level here seem very appealing. But yeah, with the CAD you just have to be very careful. Dollar yen, as mentioned, be careful of the 160 handle. I mean, we haven't been here since... I mean, if we go on the weekly, we haven't been at 160 in years. Oh, we were there in 2024. And obviously this is when we got intervention. So let me just circle this right here. This was when intervention kicked in, and we're now back at the 160. So very, 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 very risky level to be adding longs to. But if we do, this level will be here. And it is also worthy to mention that yen intervention is most, I'd say most useful or effective when the macro follows it. And right now the macro isn't following it, so we could see delayed intervention. CAD yen, similar thesis here. CAD Swiss, same thing here. I really like this level here, 573, 1-to-1 in and out. You kind of want to be in and out in these markets, but yeah, that makes good sense. Dollar Swiss, same thing there. Euro NOK, we're actually already in this, and to be honest, I like this level we're in. We should probably hit our take profit on market open if we're lucky. Euro AUD, definitely not the cleanest cross, but if we were to, this level here, 167 for sure. If I mark that out, definitely cleaner price action, but more there are more clearer divergences on a macro side of things. But yeah, 1.67, that level there looks nice. Euro pound, I had this level marked on Friday, but obviously we tagged it at 8 PM, so I didn't get into it. To be honest, if we come back down here during the London session, I'll be happy to get into some longs. Euro Swiss, similar thesis here. And that is it. Yeah, I mean, look at this. Equities are melting. They are melting. 6,400. So yeah, definitely be careful with trading equities. I mean, I don't take positions on equities personally, but yeah, that is essentially all the technicals for the week ahead. As always, definitely a quicker or a shorter breakdown this week, but that's obviously just due to markets really not changing that much. Everything's pretty much indicating continued escalation. Keep an eye on Carg Island for sure. And yeah, I mean, that's it from me. As always, drop a comment if you enjoyed it or with any questions, and we'll catch you in the next breakdown.